There is a repeating cycle in every modern economy. Not war, not coups. It is financial instability, a phenomenon that self-replicates across centuries, changing names, changing forms, but always following the same script. Humans forget their own memory. Each generation believes it is different, that the old rules no longer apply, until the cycle begins again, and history reclaims its debt. From Weimar, where hyperinflation turned money into dust and a young democracy into riots, to Japan, where the asset bubble burst and the country fell into 3 decades of deflationary hibernation, to Greece, where public debt crushed sovereignty and people lined up to withdraw money from closed banks, and now to the United States in 2025, where financial leverage, public debt, and faith in paper money are climbing together. History has changed the setting, but not the structure. Every cycle begins with stability, when financial discipline creates prosperity, then expands with greed, inflates with credit, wobbles under debt, and finally ends with reconstruction. The question is not, will it repeat, but where are we in the cycle? Economists like Hyman Minsky called it the financial instability hypothesis. The law that prolongs stability itself breeds new risks. But today we are not just talking theory. This is the modern version of the currency collapse law, the 8-stage financial instability cycle, a model drawn from Minsky, from Weimar, from Tokyo, and from every economy that ever thought itself immune to history. This cycle is not measured in years, but in confidence. And that confidence, once shaken, spreads faster than any currency ever printed. In 2025, America is not at the starting point nor at the end, but certainly it is in stage 3. If the financial instability cycle is the machine of history, then Weimar is the starkest example of humans setting it ablaze with their own hands. After World War I, defeated Germany shouldered a reparations debt of more than 132 billion gold marks, an amount impossible to pay through taxes or production. The tax collection system collapsed. Export revenues dried up, while the Allied powers demanded payment in gold or hard foreign currency. With no other path, the German government chose the familiar solution of every desperate economy: print money to survive. At first, it seemed effective. Paper money flooded the market. Unemployment fell. People were temporarily saved from crisis. But the more they printed, the more dependent they became. And like any addiction, each dose was larger than the last. In 1919, $1 exchanged for 4.2 marks. By 1921, it was 75 marks. A year later, 400 marks. Then in 1923, the price surge defied imagination. 4.2 million marks, then 4.2 billion, then 4.2 trillion for $1. Bread that cost 1 million marks in the morning was 2 million by afternoon. People pushed wheelbarrows of money to the market just to trade for a loaf of bread or a bundle of firewood. Children played with stacks of money like paper, while adults burned it instead of wood because it was cheaper. The mark, once a symbol of German discipline, became the world's joke. In stage 1, Germany had stability and prestige, a strong mark, advanced industry, national confidence. But moving to stage 2, when the government loosened credit to heal post-war wounds, the economy began to slide. Stage 3. Public debt ballooned. The Reichsbank printed money to fund deficits. Stage 4. Everyone believed the government would control it, until no one wanted to hold marks anymore. Stage 5. The liquidity shock hit as confidence evaporated. No one accepted money, commerce paralyzed. Then stage 6. Inflation became a storm. Money lost its function. Prices raced ahead of printing. People spent wages the moment they received them, because waiting an hour meant losing more value. The monetary system died, dragging the entire economic life with it. Taxes could not be collected. Wages were insufficient. Production halted. By stage 7, the state desperately intervened with administrative measures. But all controls were meaningless without confidence. Weimar society disintegrated, riots, political extremism rose, and then stage 8, the ultimate reversal point. In November 1923, the government issued the Rentenmark, pegging its value to land and public assets instead of gold. By tying money to something tangible, they restored confidence, halting hyperinflation in weeks. But the price was profound social crisis and a politics out of control, which later paved the way for the darkness of extremism. Weimar became an eternal warning to every nation that believes it can print its way out of debt. Because when currency loses value, everything built on it, contracts, confidence, society, collapses too. Printing money may save the budget, but it kills confidence. And no currency has ever survived when the government turns it into a political tool. After the Weimar fire burned all value from money, history did not stop. It changed form from the ashes of inflation. The world shifted to the opposite extreme, the chill of deflation, and Japan became the living proof of that. An economy that did not burn, but slowly froze over 3 long decades. In the 1980s, Japan was the model of stability and prestige, a perfect stage one, a strong yen, abundant domestic savings, technology and exports dominating the globe. But that very stability bred the illusion that growth was a birthright. After the 1985 Plaza Accord to offset the impact of the yen's appreciation, the Bank of Japan cut interest rates to rock-bottom levels. Cheap money flooded in, land and stock prices skyrocketed endlessly. A small apartment in Tokyo was worth more than a building in Manhattan. Stocks tripled, quadrupled. In 1989, the Nikkei index hit nearly 39,000 points, the all-time high, and also the peak of stage 3, the phase of leverage and delusion. Private debt exploded. Companies borrowed to invest in land, banks used appreciated collateral to secure new loans. The entire financial system became a feedback loop. Rising prices led to more borrowing pushed prices higher. That was stage 4, the phase of concentration and risk amplification, where everyone knew the bubble existed but no one dared stop. Then in 1990, the bubble burst. In just months, the Nikkei lost over half its value. The real estate market collapsed. Land prices fell 80% in many areas. Collateral evaporated. Banks were stuck with massive bad loans. This was stage 5. The liquidity shock not from collapsing faith in money, but from collapsing faith in asset values. From there, Japan entered the deflationary era, stage 6, the cold resolution phase. Unlike Weimar, where money lost value by the hour, in Tokyo the yen became too strong and people stopped spending because they believed tomorrow would be cheaper than today. The banking system turned zombie, alive, but not growing, carrying unmanageable bad debt. The Bank of Japan experimented with unprecedented measures, cutting rates to near zero, then negative, buying bonds to keep markets alive, and in the early 2000s launching the first QE program in modern history. Still, growth stagnated. Inflation near zero. By stage 7, the state became the heart of the economy. The government borrowed for public spending, recapitalized banks, intervened in bond markets, and ultimately absorbed the national balance sheet. Public debt rose to 250% of GDP, the highest in the developed world, but without crisis, because most debt was held by citizens. Japan invented a strange stabilization mechanism, YCC, yield curve control policy, allowing the government to dictate its own borrowing costs. That was how they froze time, preventing economic collapse, but also preventing revival. And by stage 8, they re-anchored confidence through stagnation. Low growth, near zero inflation. Markets stable to the point of paralysis. A generation born and aged without knowing the feel of inflation or explosive growth. Japan avoided a Weimar-style crash, but in exchange for 3 decades of ice, where restraint became policy and stability became both goal and trap. The world sees Japan as a quiet miracle, an economy that does not collapse but never revives. A living witness to the modern paradox, when people fear fire so much, they willingly freeze the future. After 3 decades of ice in Tokyo, history veered in another direction, this time not freezing but bleeding. Greece became the proof of the tragedy of a nation bound in a debt web where it could not print money to escape, only cut into its own body to survive. Upon joining the Eurozone in 2001, Athens believed it had entered an era of stability and prosperity, but in reality, that was stage 3 of the cycle, the phase of leverage disguised under the name European integration. The euro brought confidence, and confidence brought cheap credit. International investors viewed Greek bonds as nearly as safe as German ones. The government borrowed recklessly for public spending, civil servant salaries, expanded welfare, infrastructure projects, and the lavish 2004 Olympics. In stage 4, risks accumulated but were obscured by the glow of growth. European banks rushed to buy Greek bonds for higher yields, believing the Eurozone would bail out everyone. That was the familiar feedback loop. Easy credit created deficits. Deficits were fed by new credit. Everyone knew the numbers were fake, but no one dared say it. Then in 2009, the curtain fell. A new government revealed the truth. The budget deficit was not 6% of GDP as reported, but 12.7%. Markets reacted as if discovering a national accounting fraud. Confidence collapsed. Bond yields soared. Greece lost access to new borrowing. The confidence shock was stage 5, and for Greece, it came not from war or banks, but from exposed truth. Entering stage 6, normally a country would print money to soften the fall, but Greece could not. They did not own the euro, they only borrowed it. No devaluation mechanism, no issuance rights, only spending cuts and tax hikes. In 2010, Greece received the first bailout from the European Union and the International Monetary Fund, with strict austerity conditions. The economy shrank 25% in just a few years, unemployment topped 27%, tens of thousands of businesses went bankrupt. By 2012, they had to conduct PSI, private sector involvement, the largest debt haircut in European history, forcing private investors to accept losses of over 100 billion euros. But the wound was not healed when in 2015, after years of political crisis and violent protests, Greece fell into stage 7, regime shift. The government closed banks, imposed capital controls, limited withdrawals to 60 euros per day. People queued in long lines at ATMs, watching their futures locked behind cold glass. The collapse came not from inflation, but from liquidity shortage and fear of losing political control. The European Union saved Greece with a third bailout package in exchange for ceding part of its fiscal sovereignty. Tax agencies, budgets, spending policies all under Brussels oversight. That was the European-style reset. No printing money, no total collapse, but survival through enforced discipline. By 2018, Greece exited the bailout program, but the economy never returned to pre-crisis levels. Confidence slowly recovered, but scars remained, a once proud democracy now learning to live within limits. Their stage 8 was re-anchoring through constraints, a nation learning to exist within the framework of a currency it does not control. Greece is a warning to every small economy in a globalized world. When you cannot print money, you must cut flesh. When debt is the symbol of confidence, losing confidence means bleeding out. And in the era of common currency, crisis does not need to be printed, it only needs to be revealed. If Greece is the tragedy of a nation that lost the right to print money, then America is the paradox of one that can print as much as it wants, and thus can destroy itself without knowing. After the 2008 financial crisis, the United States entered stage 1 and stage 2 of the cycle with a temporary victory. The Federal Reserve saved the system with record low interest rates and quantitative easing, pulling the economy from collapse. That was the era of artificial stability, low inflation, falling unemployment, Wall Street booming. Cheap money became the natural state. Stimulus policy became habit. Everything seemed back to normal. But every rescue measure left after effects. A decade later, stage 3, leverage buildup, had clearly formed. U.S. public debt exceeded $36 trillion, equivalent to 120% of GDP, the highest in peacetime. Every year, the government spent trillions more than it collected. Even in growth years, deficits remained massive. What was called deficit spending was no longer a tactic, but a structure. In the private sector, leverage also ballooned from real estate to stocks, from tech companies to hedge funds, everything funded by cheap debt. Asset bubbles spread, stocks hit peaks, real estate reached record prices, and the AI mania wave swept away investor reason, just like .com in 2000. When everyone believes new technology will change economic laws, history usually responds with a fall. Beneath the growth glow, stage 4, concentration and feedback loops was forming. Government interest costs rose rapidly, nearing $1 trillion a year, higher than the defense budget. Every percentage point increase in rates added hundreds of billions in debt. The financial system began exposing weaknesses, repo market volatility, bloated carry trades, hidden leverage in non-bank funds and derivatives. The bond market, the backbone of the dollar, became more fragile than ever. A liquidity shock, even small, could spread globally because the USD is the lifeblood of all cash flows. Stage 5 could begin, not with a crisis, but with a technical event. A failed treasury auction, a foreign central bank reducing USD reserves, or a confidence dip in treasuries. BRICS and developing nations have started diversifying reserves, dropping USD share from 70% to 58%. Oil trades in yuan or rubles remain small but symbolic. The world is preparing for a new order where the dollar is no longer supreme. From here, America could take two paths. Path 1. Inflationary resolution. The government prints money to pay interest and maintain spending. The Fed buys bonds to stabilize markets. Inflation returns, perhaps not Weimar hyperinflation, but enough to erode currency value and global trust. The USD loses appeal, bonds lose absolute safety. That is controlled inflation until it is not. Path 2. Deflationary resolution. Conversely, if the Fed fights inflation resolutely, high rates choke growth, burst asset bubbles, and lead to deep recession. Stocks, real estate, and corporate credit plummet. Markets force the Fed back to QE, but by then, tools are blunt. A Weimar Japan hybrid cycle, half hot, half cold. Both paths are painful, differing only in speed and form, and between them is a cold truth. America is paying the price for 15 years of cheap money and 50 years of overspending. Yet America remains different, and that is what makes this story unfinished. The economy's scale, treasury market depth, technology, energy, and geopolitical power are protective walls no other nation has. The dollar is not just money, it is the system. And as long as the world trades in it, Washington has time, but time is not infinite. If public spending keeps outpacing output, if policy only revolves around short-term rescues, the cycle will choose for us. There is a limit. Even a superpower cannot buy confidence. And when that confidence wavers, no weapons, technology, or central bank can save the currency's value. America still has choices. But if it does not change, the cycle will choose for us. Every cycle ends, but not every ending is collapse. History gives us 3 exits, 3 models of conclusion, and America today stands at that crossroads. Scenario 1. Controlled adjustment. This is the path of Britain after World War II. An empire that understood its era was over and accepted landing. The pound lost reserve status, colonies left, the currency devalued, but society retained order. Decline happened gradually, no explosion, just a smoldering transfer of power. America could choose this if it accepts spending cuts, fiscal restructuring, and a multipolar world where the dollar is no longer the absolute center. An American century could end without war or collapse, only through disciplined adjustment. Scenario 2. Chaotic break. This is the tragedy of Weimar, when the government chooses printing over facing debt, when faith in currency vanishes, and society is pushed into chaos. Hyperinflation does not just destroy wealth, it destroys moral structure, because when money loses value, every promise and law based on it dissolves too. A democracy can turn to dictatorship simply because it cannot pay the bills. For America, this scenario is not impossible. If politics remains paralyzed, if spending and public debt keep climbing without discipline, if the Fed is forced to print to fund the Treasury, inflationary fire could spread. It need not reach Weimar levels. Just partial loss of dollar faith would reshape the entire financial order. Scenario 3. Regime reset. This is the middle path, like Japan and Greece, a controlled restructuring where the government keeps the system alive by accepting rising debt, controlling yields, and redesigning rules. No collapse, but no revival. Low growth, low inflation, stable but stagnant society. That is stability through stagnation, a fragile balance between past and future. The world could enter this phase, a new cycle of control, digitization, and financial oversight, where confidence is maintained not by gold or production but by management and technology. All 3 scenarios differ in speed but share one law: when currency is the foundation of power, losing confidence means losing empire. Yet losing power is not annihilation. Britain rebuilt, Germany reborn, Japan still stands. Every empire can fall financially, but if it retains discipline and confidence, it can rebuild. That is the difference between ending and rebirth. Because in every cycle, the death of a currency is not necessarily the death of a nation, but only the signal that it is time to rewrite the rules of the game. The cycle is real, but the outcome is still a choice. Every empire in history is a variation of the same story built on confidence, lost through its abuse. Weimar burned its currency to pay debts and traded for chaos. Japan evaded pain by freezing time, living in cold stability for 3 decades. Greece endured cutting its own flesh to survive, losing sovereignty but keeping its soul. In America, the financial empire of the age is entering the testing phase, where decisions no longer lie with markets but with collective will. The cycle cares nothing for nationality, institutions, or technology. It only reflects human nature, greed, fear, and forgetfulness. When stability lasts too long, we believe risk has vanished. When money is easy, we forget real value cannot be printed. When prosperity endures, we think ourselves immune to history, but history does not repeat. People do. And the cycle is merely the measure of collective memory, recurring whenever we forget old lessons. America can become the next chapter, or the first exception. It can repeat Weimar's mistakes, prolong Japan's ice age, or accept restructuring like Greece. But it can also choose a new path, the path of discipline, creativity, and reconstruction. The question is not, does the cycle exist, but do we have the courage to break it? If you want to know what's coming, don't look at headlines, don't listen to market noise, look at the cycle, because it never lies. The pattern is real, but the outcome is still ours to choose. If this makes you see the financial world differently, subscribe so you don't miss the next part of the cycle. See you in the next chapter, where history is still being written, one number at a time.